So in my previous video I went over the Trinity study, which showed why, according to their calculations, the 4% rule was a safe withdrawal rate when you reach retirement. Nevertheless, it's widely accepted by the FIRE community as a benchmark target, leading to my favorite finance YouTubers such as Stephan and Felix to question this principle. But here's where they differ. Stephan says the new norm is over 4%, more like 5%. He comes to this conclusion based on what one of the authors of the original Trinity study had to say, that effectively the 4% rule was based on different market conditions and that in recent times this number is greater than 4%. Felix, on the other hand, refers to studies by both Professor Wade Foe and their own research from PWL Capital to say that this number is much lower, that is 3.5% or even 2.2% if investing globally. So forget about the 4% rule. According to Ben, it's 3.5% or even lower. So now, thanks to Graham and Ben, we're even more confused than before. Thank you guys. Okay, let's take a step back for a minute and work things from the ground up and from simple principles. First, we need to understand what exactly did the Trinity study look at. And that's exactly what my previous video covered, and in case you haven't seen it, the link should be up here and in the description below. So do watch the video and come back for the next part as we discuss some of the limitations and how in turn these need to be interpreted. Right, so the Trinity study used historic data to model retirement periods of 15, 20, 25 and 30 years. That's using data from 1926 to 1995. This means that some retirement periods will have the misfortune to start on a very bad year, but that's part of what finding the right withdrawal rate is, such that it is able to withstand a recession right from the beginning. But the problem with historic data here is twofold. Firstly, you don't really get that much data, and secondly, you're using data that is decades old, so it might not reflect current or near-term markets, and that's the danger. For example, if you're using data from 1926, you're using some pre-World War II data to draw a conclusion about today's stock market, which is arguably very different. The other limitation is the criteria for success being defined as not running out of money. Now that's good, but there might be a stricter criteria whereby some people want to end up with at least the same amount of money when they started so that they can leave it to someone else, particularly those with children or grandchildren, for example. As we saw from the Trinity study, at a 4% withdrawal rate, on average we end up with more money, but in some scenarios it's substantially less. So if you want to reduce your probability of ending up with less money, you may want to have a lower withdrawal rate than 4%, at least according to the logic that follows from the study. One of the weaknesses of the 4% rule is also the retirement period. The authors of the Trinity study looked at retirement periods ranging from 15 years to 30 years. And to be fair, their assumptions were perfectly reasonable at that time. Why at that time? Because the FIRE movement was not such a big deal as it is today. Today, with so much focus on early retirement, the simulations need to be adjusted to account for longer withdrawal periods. So instead of 30 years, we should probably be looking at 40 or 50 years. And that's where things diverge, because the longer the time span, the wider the range of possibilities. Longer periods means more recessions, but also more growth periods. So in theory, the longer periods would allow for better recovery and more compounding, which means you're less likely to be affected by a dip in the market. And this brings me to the last point. One of the most important elements of the 4% rule is the rate of return on your portfolio. In the Trinity study, stocks and bonds were assumed to return 10.5% and 5.7% respectively, and that was for the period ranging from 1926 to 1995. Now we all know this rate of return on bonds is very much on the high side and needs to be lowered, especially in modern times. People who make the case for a lower withdrawal rate than 4% usually assume a lower rate of return for stocks and bonds. Example, 7% for stocks and 3% for bonds. and inevitably, if you assume lower rates of return, your withdrawal rates will also need to be revised down. However, the opposite is also true. If you can consistently make a higher return, then you should be safe with the 4% rule. So, what's the verdict? Is the 4% rule really safe? The answer is that it never was fully 100% safe, but rather used to set a good rule of thumb. So if you're asking if the 4% rule is really safe, you're effectively asking if a rule of thumb is really a safe rule. And the short answer to that is of course not, because that's what rules of thumb are designed to be. Easy targets with lots of simplified assumptions. In reality, when you retire, you need to consider market conditions. And your withdrawal rate more likely needs a dynamic approach rather than a static rule of thumb. And that is exactly what I will cover in a future video. So make sure you like my video and subscribe to my channel for more content. As always, thank you for watching and see you next time.